Welcome to today's video, Coronavirus Crash, What Investors Need to Know. I'm Melissa Joy, founder and president of Pearl Planning. I'm a financial planner and I'm recording this presentation midday on March 10th, 2020. Today we're going to be talking about the current investment market environment, the current situation related to coronavirus, energy, and elections, how the market has responded. We're going to review investor behavior and how investors can manage through uncertainty in the markets. And then we'll have an actionable list of next steps that you can make as an investor. So let's talk about the current situation and go over three significant occurrences that are impacting market prices today: coronavirus, oil and energy markets, and the election. So let's start by discussing coronavirus. And first, there are some points of emphasis from this data that I collected from March 9th, 2020. And I'm not speaking to you as a healthcare professional or expert, but just an observer. And the majority of infections of coronavirus are deemed to be mild. And this is information collected by from China, where we have the most data going through coronavirus. The numbers of currently ill and recovered are broken down by percentages here as well. But what's alarming with coronavirus is, first, it significantly impacts certain groups of people, especially our older populations, as well as those with pre-existing conditions. And those factors can be extraordinarily deadly when combined. The world has become obsessed with coronavirus, and certainly that's not a criticism. But you can look at two different, kind of stats. One is how the number of deaths per day of coronavirus relative to other healthcare threats and conditions, as well as coronavirus's mentions in the media, which are just exponential at this point. So I would encourage people, I love this GIF. Think about staying in your lane. So I am speaking to you as an investor, and I am focusing on what I know, which is behaviors that can impact good results for investors. I would refer to healthcare professionals if you're thinking about how to prepare for a widespread virus or disease. So make sure that you are turning to the right experts. I don't think that medical professionals necessarily know what may be occurring in the market, and vice versa. While I did give you some statistics, I would refer to health professionals to keep an eye on what is happening with disease spread. Now, to add to the slowdowns that are occurring because of coronavirus, business interruption, impacts to supply chain, etc., the energy markets have been in a free fall, especially over the last week. So there is posturing that is occurring between Russia and Saudi Arabia that is hugely affecting energy markets. This is going to have impacts for borrowers. Energy sector is an area where there is a lot of lending going on, a lot of bond issuance. And so the sector in general, which is much smaller than it used to be as a percentage of the U.S. economy, is really heavily impacted. And that played into the issues in the market this week. Finally, elections continue to percolate, and Democrats are continuing in their primary season. Last week was Super Tuesday, and you can see kind of the three perceived finalists that are left in the presidential election race. I think that the imagery here is referring to the candidates' ages. I've heard them, the three left, referred to as that 70s show because they're all in their 70s. But as we look to see who the final two candidates will be, who will be competing against Trump as the Democratic nominee, there are also issues and impacts that are reverberating in the markets. So let's talk about recent history. and referring specifically to March 9th, 2020. Ironically, March 9th was the 11th anniversary of the birth of the last bull market. So we've had 11 really solid years of market returns. And while there have been some pullbacks, they haven't gone into bear market territory. And we're really close to that bear market territory today. So you can see that March 9th, Monday this week, was down 7.6% as measured by the S&P 500. If you look at the losses since World War II in terms of loss on a day, it was the 7th worst day. I thought it was interesting as an investor. I've been in the business since August of 1998. And so I have lived through 55% of the worst days in a little bit less than 22 years. And in spite of that, it's been a time where investors have been rewarded over time. And it really comes down to investor behavior, which we'll be speaking about in a minute. This particular market correction, right now, as of the close of business yesterday, we were at an 18.4% decline, has occurred over a 15-day period. So in fact, we were at or near all-time highs just about 3 weeks ago in terms of trading. So here's a look at how many days a correction usually occurs, or a pullback and decline usually happens, and then also the length or duration of days for recovery. And this is really looking back since that last bear market, so data that we've had from more recent markets. And you can see that the length of time for the pullbacks we had a 10-day pullback in January and February of 2018. So those time frames can be compressed, and then the duration of recovery in terms of days is often longer. And it's very difficult to predict when you'll go into that recovery phase. In fact, I would refer back to that 11-year anniversary. So March of 2009 is really memorable for me as an investor because it felt so difficult and dreary. It did not feel like the day of the best opportunity over the last 20 years, which it really was, where prices for a variety of assets were extremely low. And certainly, past performance does not predict future returns, but it really felt like a very gloomy time period, which actually resulted in a time frame that provided opportunity for investors if they maintained disciplined behavior and stayed invested. It was very tempting to have all of your money on the sideline during March of 2009. So what we haven't talked about yet is that bonds have made huge moves. And moves down. So for most of the last 10 years, people have been concerned about rising interest rates and what that would mean for economies, for growth, and also what it would mean for bond returns, especially because we have more and more retirees. Bonds are a really important part of how people plan to invest over time. And here we are today. We're at bond yields, and this is data from Freddie Mac, data on mortgages, yields that are lower than they've been in the last 5 decades. That's great if you're a borrower and you can qualify for a mortgage, but it's more concerning if you're a bondholder. And you can see on the right here, this is data from Raymond James. You look at the percentage change in yield over a time period, and we are just at huge changes for yield. So more than 80% decline since October of 18. And current, since the coronavirus was announced, almost 70% decline in terms of the change in yield. So that is a brand new phenomena that we need to deal with. And while I want to talk to you today about how investors should position themselves and how they should behave with the market pullback, I also am kind of foreshadowing that we're going to be dealing with a super low interest rate environment again, something that we thought we maybe had turned the corner from a few years ago. And so that's going to be important for positioning of portfolios. It is more difficult to be a bond investor today than it was a few weeks ago, but also bonds have been resilient in holding up as stock prices have declined. All of this goes into investor behavior, and being an investor is an emotional journey. I love these roller coasters of feelings as an investor are pre-exist emojis. So there's something that's somewhat archival, but then someone has also paired emojis so that we can see the feelings in a modern sense. I don't see a virus emoji on there, but apparently there is now a virus emoji from Apple, so look that up. But it would be easy to have felt euphoric just a month or two ago, where the market is constantly reaching new highs. You feel like making money is easy. It's much easier to take on more risk. You're comparing your returns to neighbors and you want more. And now we've been going down the roller coaster into fear, panic, perhaps anger, or depression. So it's been a quick ride going downhill after a lot of good uphill, but I'd ask you to kind of take your pulse and see how you've been feeling with market declines and news about coronavirus, concerns about public health and safety. And keep in mind that in investor behavior, it's important to manage your emotions, but also acknowledge and be kind to yourself and to others. And you can't just say, don't worry. First, kind of take your pulse and get a sense of how you're feeling with this cycle of emotions. After that, I know this gets back to kind of basics of just breathe, but work on your mindfulness. Make sure that you're separating what the news and headlines, which are automatically can be very distracting. Separate those from your actual financial plan. So for people that work for me, you know that we often talk about, what your goals are and whether you can accomplish them. And if we have been working on financial planning, I can give you information about how the market has changed and how your investments have changed in context with your financial plan. But first, what I want you to do is to be able to just take a minute and calm your emotions so that you're more able to take that information in and listen. So I wanted to make sure that you leave watching this short video with some concrete actions that you can take that I think as you reflect after the coronavirus crisis has gone away, that you'll be glad you did. And each of these is personalized, so it may or may not affect you, but these are some ideas that I'm discussing with clients. First, and most importantly, we just talked about the emotional roller coaster that is being an investor, and certainly we're on that roller coaster today. Acknowledge your emotions and avoid, if at all possible, decisions based in fear. You can use your investment policy, you can use your financial plan as a touchstone to understand what types of decisions you should make. And also use a financial planner like myself to discuss your options and what's on your mind. So give yourself some distance between your emotions and your decisions as much as possible. Also, this is a real concrete thing you can do. We are near all-time lows on mortgage interest rates, and that may apply to other debt and loans as well, depending on your credit and possibilities. So review your options and consider refinances when appropriate. You would also want to look at cost and other factors, how long you plan to be in the property. You don't want to extend your loan for too long of a period of time, but it's certainly worth considering. For investors who have taxable accounts, especially if you're in a higher tax bracket, tax loss selling is a way where you may be able to move from one investment into something similar but not the same and pick up a realized capital loss that can offset future capital gains. And we have an entire video just on that, so I'll put that in our show notes. You may consider Roth IRA conversion strategies of your traditional retirement assets. It depends on your circumstances, where your tax rates are today versus where you think they'll be over time. But putting money into Roth accounts when markets are lower and then investing it to go higher can be an effective strategy. The same goes for accelerating contributions to things like college savings accounts, retirement plans, etc. So you may want to front load your contributions into a retirement account into the beginning of the year, or if you're gifting to a 529 plan, consider making that gift while the market is lower and then going on to invest those gifts. If you're a high net worth investor who makes gifts to move to other generations or trusts outside of your estate, making those gifts during this time period may be an effective way to get a bump in terms of what you have over time in those types of accounts or to those people. Also consider rebalancing your accounts at some point. So as bonds have gone up and stocks have gone down, then a consideration may be that you move assets so that they go back into your preferred mix. And if you just aren't comfortable with the strategy that you have, or if you bailed on your investment process, so you said you had an investment process, but now you find yourself sitting in cash, then look over what your strategy is and get to a process that you can stick with both in good markets as well as in difficult markets. And then also consider what ways that your plan can have risks mitigated. So if you're not going to be spending as much, if you have cash on hand for some of your needs, those are ways that you can remind yourself that you don't have quite as much risk as it may feel. Also keep in mind that your time frame is really critical. So for many of us, even if you're very near retirement, you have another 30 years that you need to work, that your investments need to work for you, I should say. So keep that time frame in mind as you react to current market conditions. So if you're looking to discuss this further, whether we work together today or you are looking for someone to work with, don't hesitate to reach out. I've included my email address, and we have Pearl Planning has offices both in Dexter, Michigan and Grosse Pointe, and we work with clients all over the country. So those are I've provided contact details in case you'd like to reach out. We'll make sure to keep you posted on updates, and we always have information both in our newsletter, which you can find from our website, pearlplan.com, as well as our blog and YouTube channel. So stay in touch, and we hope that you found this information informative. We'll keep it coming as new news comes into the market. Thank you.